Welcome to the video. Today we will unpack why so-called inheritance advancements tied to real estate improvements, like building an ADU on a child's property, often create hidden financial traps. We'll also cover a simpler, fairer approach that avoids conflict and preserves liquidity. Throughout, we will use diagrams, examples, and a couple of quick quizzes to keep things engaging. Let's begin. First, we will define what an advancement is. Next, we will examine why funding an ADU and deducting that cost from a future inheritance often produces an illusion of fairness. We will identify the hidden costs and liabilities that come with unwanted structures. After that, we will separate the discussion of caregiver responsibilities and why they must be compensated distinctly. Subsequently, we will present the simple KISS plan: fair market purchase, parents fund and own, and then an equal split on death. We will close with actionable steps, 2 quick quizzes, and the key takeaways. To start, an advancement is essentially a prepayment of inheritance that reduces the recipient's future share. In a real estate context, parents might fund land or construction on a child's lot and later deduct those amounts from that child's inheritance. While this may appear even-handed, it frequently creates inequities because liquid estate assets shift toward other heirs while the recipient inherits long-term liabilities and an asset they may not want or need. Now let's explore why this feels fair, but often is not. If parents spend $50,000 on land and $125,000 on construction, then later deduct exactly $175,000 from the recipient's inheritance, the recipient is effectively paying for the improvement with their future inheritance. That recipient ends up with an ADU and a reduced cash share. Meanwhile, the other heir receives proportionally more liquid assets like cash or marketable securities. The ADU imposes ongoing costs such as property taxes, maintenance, insurance, and potential permitting issues. If the structure is not desired or needed, the recipient carries a burden without true compensation. In this pie chart, we visualize the advancement scenario. Heir A's cash portion is $237,500. Heir B's cash portion is $587,500. An additional segment represents the $175,000 effectively locked into the ADU on A's property. This depiction highlights how the advancement shifts liquidity toward the other heir, while A carries a non-liquid improvement and the associated obligations. Next, let's compare models. Under the advancement approach, the recipient's liquidity shrinks. They inherit ongoing costs, accounting becomes complex, and there is elevated risk if testamentary documents change later. Caregiving gets muddled into inheritance arithmetic, creating resentment. By contrast, under the KISS approach, parents purchase at fair market value and fund the ADU with their own money, keeping ownership separate. On death, the estate is split simply and equally, or, as specified in the will, minimizing disputes. Caregiving compensation is handled through a distinct agreement, separate from inheritance calculations. Moving on, here are practical steps to implement this simple plan. Obtain an independent appraisal of the land. Parents then purchase at true fair market value. Parents fund and construct the ADU using their own accounts, contractors, and contracts, and they retain ownership while alive. Update the estate plan to reflect an equal split or the intended allocation. Create a separate, written caregiver agreement with defined duties and pay terms. Finally, revisit all documents regularly and after major life changes. Here we show a timeline beginning with a month 0 appraisal, then a month 1 fair market value purchase by the parents. From months 1 to 4, design and permitting occur. Construction runs approximately months 4 through 10. Occupancy begins around month 10. At that point, the estate plan is updated to reflect the intended equal split. Annual reviews of the trust and caregiver agreement follow, ensuring the plan stays aligned with reality. Now let's address caregiving. Care duties should be compensated distinctly and not folded into inheritance deductions. Establish a written caregiver agreement with clear duties, hours, pay rate, and reimbursable expenses. Payments should flow cleanly, for example through a trust or designated account, and should be documented. Reimbursements are separate from gifts or advancements. Transparency around process and records reduces sibling conflict and perceptions of financial exploitation. Additionally, there are hidden costs. Property taxes generally rise with the assessed value of the added structure. Maintenance costs accrue each year, including repairs and landscaping. Utilities often incur base charges, even without full-time occupancy. Insurance premiums may increase. There is also compliance risk with zoning, permits, or homeowner association rules. Finally, resale can become more complex due to a narrower buyer pool or appraisal challenges. These costs and frictions reduce the net benefit of an unwanted or unneeded ADU. Before proceeding, please note this is educational content and not legal, tax, or financial advice. Rules vary significantly by jurisdiction, and individual circumstances differ. Always consult a qualified attorney, tax advisor, and financial planner to ensure your plan complies with local law and meets your objectives. Quick quiz. If parents fund an ADU on one child's property and later deduct that amount from that child's inheritance, what is the most likely financial effect? Options are A. The recipient gains both liquidity and a free structure. B. The other heir receives less cash while the recipient gains more. C. The recipient effectively pays for the improvement with reduced future liquidity. D. There is no change in any heir's liquidity. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. When the improvement cost is deducted as an advancement, the recipient is essentially paying for the improvement with their future inheritance, reducing their liquidity, and often adding ongoing expenses. Second quiz. Which approach best follows the KISS principle in this context? A. Parents discount the land and call it even. B. Parents buy the land at fair market value, fund the ADU themselves, and the estate splits simply later. C. Parents fund the ADU, record an informal IOU, and adjust later. D. Combine caregiver pay with inheritance math to simplify documentation. You may pause the video now to consider your answer. We will cover the correct choice in the next section. The correct answer is B. Purchasing at fair market value, keeping funding and ownership on the parents' side, and splitting the estate simply upon death preserves clarity and avoids complicated deductions or perceived inequities. To summarize in a concise checklist, do use independent appraisals and fair market value purchases that keep ownership clear. Do not trade liquid inheritance for a property improvement you did not request. Always separate caregiver compensation from inheritance mathematics. Finally, document agreements, reimbursements, and conduct annual reviews so the plan remains current. As we wrap up, remember that advancements tied to real estate improvements frequently shift liquidity away from the recipient and saddle them with ongoing liabilities. The KISS approach focuses on a fair market value sale, parents funding and owning improvements, and a simple split at death. Caregivers should be paid separately, with clear documentation. Clarity now significantly reduces the risk of family conflict later. Finally, thank you for watching. If this video clarified the pitfalls of advancement in estate planning, please like, share, and subscribe. Tell us in the comments how you are approaching ADUs, fair market value, and caregiver agreements. Your experiences can help others make better decisions.